Hi Veena, how are you?
Hi Kumar, I'm fine. How are you?
Yes, I'm good. Now you are relaxed little bit with your mother-in-law being there.
Yeah.
at least, at least one part of the work can be delegated.
Yes, exactly.
Yeah, yeah. As you
Yeah.
said, we will definitely have more classes from now onwards
Mm-hmm.
till the exam. We'll try to fix up a few days here and there, uh,
Uh-huh.
and then we will see, because now we have done some mocks. We will try to do more mocks, and as I said, uh, I have already sent you something, but we will discuss those. But I will send you some
Mm.
more mocks in time to come.
Mm.
So we will try to work it through. I just want to quickly look at some of the questions or some of the accounting standards what you mentioned. Uh,
Mm-hmm.
Actually, anything from F2 syllabus is possible in the
Mm.
question paper. So particularly looking at some of the
Mm.
standards what you referred, particularly the IS 36, it's all about the impairment of
Mm.
assets, right? So
Right. Yeah.
there can be a question, because we can see, if you look at the non-current asset, there is investment in films. They
Mm.
are not given any big details about the investment in films. My thinking, as I have always said, it's a non-current asset. The presentation, I think, is not right properly. Uh, my
Mm.
my thinking, investment is films is the films what they are producing, which is in the work in progress stage.
Okay.
That's what I feel. I think I'm right on that one, because they don't show
Mm.
any inventory or anything, because film is not something which will come tomorrow morning. It takes a long time to process and produce the film. So whatever they have spent on the film is what they show it as investment in films. The
Right. Yeah.
justification why they have classified under non-current assets, which I think is wrong, is basically they must be thinking the film is not going to come up in next 1 year's time, and therefore they are showing it as a non-current asset. But you have to remember, in the IAS 16, what is a non-current asset? Non-current assets are assets that are held not for sale,
Mm.
not for
Right.
sale, but to be used in the business. So property, plant and equipment surely is non-current assets.
Mm.
Right? But investment in films is something like a current asset. It can take longer time, but it's like a current asset. It is work in progress.
Right.
So
Yeah.
as I said, this paper, uh, my belief is you are the finance manager. They might
Mm.
ask you some of these classifications in the financial statements. So that's why I thought I will take a little bit of time with you today on that area, particularly to look at this statement of financial position and the profit or loss statement. So
Mm.
uh,
Okay.
they are given it as at 31st December 2016. We are in February 2017. Surely the accounts are not yet audited. So it's a draft set of presentation what they are giving. So they might ask you, whoever might ask you, what is this investment in films? Is it correct to classify it under non-current assets? So you might
Mm.
want to talk about, I want you to note down and
Yeah.
probably look at the IAS 16, the definition
Mm.
given for non-current assets.
Okay.
Right? Non-current assets. Non-current assets are all the assets that is held by the company, not usually meant to be sold.
Mm.
It will be sold later on, after some time you will sell the non-current assets, but not usually meant to be sold in the normal course of business.
Okay.
So, so the first item I think is something like work, but property, plant and equipment surely is a non-current asset. You can see it's
Mm.
a very small amount comparatively, and that
Mm-hmm.
property, plant and equipment will be subject to IAS 16 for depreciation. You remember,
Mm.
land is not depreciated, but
Mm.
buildings, plant and equipment
On
all
it.
should be
Yeah. Yeah.
depreciated on IAS 16. There are two methods. One
Right.
is the historical cost method. The other one is the revaluation method.
Hmm.
Either way you can do it. But wherever we have non-current assets, the IAS 36 applies. That is for impairment of assets. The purpose is to ensure that all the assets are not carried at anything more than the fair value, or more than what we call the receivable amount. So you provide depreciation. After providing depreciation, if you find that for any reason that the property value that is in the balance sheet or the statement of financial position is more than the fair value or the realizable value, that amount immediately should be written off. The difference should be written off straight to the P&L of that particular year where you discovered the impairment.
Okay.
This specifically applies for the goodwill. Goodwill, right?
Right.
Goodwill is arising basically in this statement. What we have is a consolidated statement of financial position. Goodwill arises when we acquire subsidiaries, and when we have to pay a price higher than the fair value of the assets, that difference is considered as goodwill.
Okay.
Right. So that is how under goodwill comes, and that is the definition that is given under IFRS 3 business combinations.
Right.
So goodwill is the excess consideration you pay over and above the fair value of tangible assets, that whatever you acquire, the difference is what we call the goodwill. So because it's F2, goodwill can be tested. You can see in both these years, the goodwill has remained at 330.
Okay.
Right? Goodwill, we don't even during our time, goodwill was amortized. Amortized means it is written off over the useful life period of the asset. Just like depreciation, depreciation is for tangible assets. Amortization is for intangible assets like goodwill. But since the IFRS 3 came, goodwill is never amortized. Goodwill is tested for impairment. Every year, goodwill will be tested for impairment by a kind of a professional valuation or through a professional analysis. And if there is any impairment that is found, that amount should be written off to the profit and loss straight away, and goodwill should be brought down to the particular value.
Okay.
So IAS 36 will definitely apply to goodwill. So probably maybe they might ask a question about the goodwill at 330. Goodwill at 330, should there be any impairment? Yes, they must look for impairment. That is IFRS 3. But if there's an increase, you will not take credit for the increase. Say, for example, you might find the 330 going up to 340 because some of the subsidiaries you have taken is doing very well and the goodwill is bigger, but you will not take it. Goodwill always appear at the cost of acquisition or the acquisition price, and after that, any impairment we will write off, but no improvement will be ever increased.
Okay.
So that's something which we need to know. And as far as the IFRS 3 is concerned, goodwill comes up in consolidated statements whenever we take a subsidiary. So here you remember we have basically, if you look at the film manufacturing, we have one company for each film, like typically, which is owned by us partly, which is owned by another party partly. So that becomes a subsidiary for all purposes, right? So that will be consolidated, and that consolidation, there can be a kind of a goodwill, but very unlikely of a goodwill there, because it's almost a new company that we are starting just to produce the film. So we may not have too much of goodwill in a new company like that. Then we have two other companies. We have one, our own 100% owned distribution company, which is a general company. It's not for a film specific. 100% owned distribution company called the Maintain Distributors. And then we have for each film another company called Maintain, not the Maintain, it's the film name Production Company. That is also 100% subsidy. So if you look at the structure here, we have the parent company, the Maintain. We will have many subsidiary companies for each of the films what we are doing. Right? Partly owned by us, 60%, 40% by outsiders, non-controlling interest. And then we will have a fully owned subsidiary company called distribution company and many fully owned subsidiary companies called production companies. That is what we can see from the film thing. But there may be other, historically they would have acquired some competing companies, and that may be the goodwill that is appearing in the balance sheet.
Right.
Which they have not given us any details, but they might give it to us on the unseen, something about that kind of a scenario. Right? So basically that's about the IAS 36. Then we saw IAS 37, we saw in earlier question what we were doing. It is all about the provisions, contingencies, contingent liabilities, contingent assets. What is a provision is always, what is a liability? It's a present obligation.
Present obligation.
Yeah, arising from a past event, which is probable. There is a probable economic outflow in the future. That is what a liability is. And it becomes a provision when the specific amount and the certain timing is not really certain, then it becomes a provision. The amount is not 100% sure, the timing is not 100% sure, then it becomes a provision. And a provision should be, if it is measurable, it must be provided. If it is measurable, right? That is what a provision is. Specifically, IAS 37 exempts certain things, not exempts, excludes things like future operating losses. Obligations can come up in two ways. One is a legal obligation, other one is a constructive obligation. What is a constructive obligation? It is something that is coming from the practice. Say, for example, when you shoot in a film, you have had a practice whenever, if one of the crew members get injured, that you bear all the medical expenses or whatever it may be. That is a constructive obligation. So when you have done it once, when you have done it twice, it becomes the practice, and then third one, fourth one also, you have to make a provision. It becomes a liability. Or sometimes in your own internal circulars, you may have set these things up, provided for our people. In that case, again, it will come up.
Right.
So these are some of the things that you may want to know about as far as IAS 36 is concerned. Then the other standard what you spoke about is IAS 38. It's all about the intangible assets, the classification for intangible assets, and all what we need to do. Here, I don't see, except for goodwill, any intangible assets. But intangible assets is one of the biggest intangible assets. You remember what we have is research and development.
But Kumar, just sorry to interrupt you. The IPR is also the intangible asset, isn't it?
What is that?
The intellectual property right.
In the intellectual property rights are intangible assets. Copyrights, all those are intangible assets. They have not shown anything here in the balance sheet, but they can have. They can have because they are taking lot of copyrights of certain films. It can be an intangible asset, but once the film is done and film is over, it's no longer intangible asset. Right? What is asset? Asset is something, again, just like a liability. Asset arises. It's a resource that is controlled by the entity, which arises due to some past event and which will give you future benefits. That is asset.
Right.
As a definition given for intangibles or tangibles or current assets or non-current assets, the definition given is a resource that is controlled by the entity. Remember, you don't need to own something. That is why the leasing comes up. You don't need to own if you can control the particular resource, and if it has arisen due to some past events like you have bought it or you have signed a contract, and if it is going to bring future economic benefit, it's an asset.
Right.
So for you to produce a new film, you might take a kind of a intellectual rights or something like a copyright that becomes your intangible asset.
Right.
So that's how our intangible assets will come into the scene. There can be many intangible assets, things like patents, things like copyrights, things like intellectual rights. All those are what we call intangible assets. You remember intangible assets, we can't our own intangible assets, we can't bring it into our own balance sheet. The reason is we can't put a value, a good fair value, therefore you can. But if you buy an intangible asset, like a copyright, like a patent right, you can show that as an intangible asset. Intangible assets are subject to amortization.
Right. Okay.
Tangible assets are subject to depreciation. Intangible assets are subject to amortization. It's over the economic life period, you must write off. The only intangible asset that is not subject to amortization is goodwill. Goodwill is also intangible asset, but that is not amortized, that is impaired every year, and whatever the difference will be written off.
Okay.
So that's something that which you need to know. One of the items under IS 38 is research and development expenditure. Now these film companies, so far they don't have anything. We do not know. They may be doing a lot of research work.
Right. Hello?
I was just trying to see whether they have anything in the P&L. They don't have anything in the P&L, but they might have certain research being done on 4D films, on new film technology, all that. So the accounting standard IS 38 says any research expenditure should be written off. Any research expenditure, whatever in the form, should be written off. Never capitalize research expenditure. So you might have a question saying that they are going to spend something on research and development, and the amount is material, significant, all that, and the research amount is so much. What is the accounting treatment? IS 38 says straight away, all research should be written off to the profit and loss in the year they incur.
Right.
Development expenditure, that is expenditure that is to develop the thing, that what you spend, can be capitalized provided it is going to have commercially viable product in the future.
Okay.
Right? You develop something, a film maybe, and then if it is going to be commercially viable in the future, in the opinion of the board of directors, then that part of the development expenditure can be capitalized.
Right, yeah.
Right? But if it is not commercially viable, that also should be written off. Also, you must be able to show that you have enough resources to complete the development project which you have started. Because the development project becomes viable only if you can complete it. So half completed development you can capitalize, but provided you can show that you have enough resources to complete the project. If your company is going bankrupt or something like that, it may not be possible.
Okay.
So these are little things what you need to get on that one. So that is all about the IS 38. IFRS 3 is something which we discussed just now, what we call business combination. It's all about when we acquire a control of a business. Now, goodwill arises only if we acquire a control. When we have a control over another company, only we can call it a subsidiary.
Right.
Generally, it is assumed if you have anything more than 50% of voting rights as I said, it is assumed that we will have a control. Right? And what is control? Control is the ability for you to exercise power, and that power is defined as your ability to receive varying returns. Varying return means you have the control over that company to decide what the dividend is going to be.
Okay.
Right? So if you can control a company, you can decide the dividend. Varying return means it's a varying dividend. It can be 20 cents this year, 40 cents next year. That is why preference shares are never a controlling share, because the preference shares, you don't have a right to vary the dividend. You are restricted to a permanent fixed dividend. So that is why it is not considered as a kind of a varying. Preference shares are not considered as controlling shares. So that's another area. And coming back to preference shares, in this company, we don't have preference shares. But another question may be, they might want to raise some money. At the moment, they have only 98 million in the bank account. Not good enough to do any film or anything like that. They might want to do a new film. They might want to raise some money. Right? So one way for them to raise is to go for equity shares. Equity shares. Issue share capital and raise money. This company probably can do that one, because for last 2 years they have not issued any shares. And if I remember right, yes, they paid a dividend last year. Right? We worked out a dividend. I think they paid a dividend. So they are generally all right, a good candidate for a issue. But you remember, only they can go for a rights issue.
Right.
Once only you can go for an initial public offering. Before initial public offering, you can go for a placement. But after this, it's all rights issues. What is a rights issue? Issuing shares to your existing shareholders or offering shares to your existing shareholders at a discounted price below the market price. Right? And it is given in proportion to what you hold, because it's coming at a discounted price. All may want to buy it. So they can't allow everyone to buy every quantity. So they will give it in a proportion. You remember here, they have not given us anything about equity shares. They have not told anything about the number of shares or anything. So there may be a little bit more information in this case study in the unseen.
Okay.
So another way they can go is for a loan. They seem to have taken a loan, because from 340 it has gone up to 350. The loan balance, 2015 was 340, but it is 350. You can't come to a conclusion saying they have taken a 10 million loan, because they may have taken a 60 million loan and paid 50 million during the old loan. They would have paid something, and a new loan they would have taken. So you can't come to a conclusion saying on a 10 million loan they are taken, because the 340 balance, they would have settled something, maybe 60 they have settled and came down to 280, and they have taken another 70 million during the year, and that is why 350.
Right.
So they have not given us a cash flow statement, so we don't know exactly the details of the loan movement, but we know surely loans have moved upwards.
Okay. Yeah.
So little movement, but there is a movement. So that's another way they can raise money. This is a public company. They can go to the stock exchange, get a list. They can issue bonds. They can issue bonds,
Right.
and also they can get a bank loan. One thing I think I said sometime back, Fawzan, you remember this company will have some non-controlling interest. The people, the 60% owned by us, the 40% is non-controlling interest. Now we don't see in this consolidated balance sheet anything about the non-controlling interest. So that's why I say this balance sheet, this statement of financial position, seems to be somewhat erroneous in the presentation. Because you remember they said they applied IFRS. If they applied IFRS, surely they must have a non-controlling interest element, and that should be just under equity, retained earnings. The next figure should be non-controlling interest.
Okay.
So we do not know where they are showing. Maybe that, that there's a line called film obligation and production loans that may be included there.
Okay.
Film obligations and production loans that may be included there. So we have to wait. But surely this presentation is something that they might test us in one of the variants. Surely this presentation is very erroneous in many aspects. And another aspect you will see is the current liability. There is no component of current liability shown in this balance sheet. If they apply an IFRS, even the long-term loan, the next year capital installment that you are going to pay should be shown as a current liability.
Right.
According to IS3 presentation, it should have been there, but they don't seem to be doing that one. Right? So that's another area. So film obligations and production loans may include all those equity part of it and all that. So which probably the presentation seem to be not right. They may have to go on changing. We don't know what is deferred revenue. They are showing it as a current liability. Not a current liability, as a liability. Normally we have something called deferred tax.
Right.
Deferred tax, right? That is the due to timing differences, the tax that is there, we show it as a non-current liability and we call it deferred tax. So they may be referring to that one, or maybe some revenue they have taken credit already, but they don't want to take credit immediately, but they are putting it in a thing. This could be one thing, the deferred tax. The other one could be something like advances we had taken for the films that is yet to be shown. Maybe with the cinema owners, we have taken certain money as advances to show the film, and that may be showing here. We do not know. See, in this balance sheet, no current liability, so we do not know. You remember, a company paying taxes, unless the taxes are paid in the same year, the tax should be shown as a current liability always, isn't it? So last year there was a 36 million, this year there's a 34 million tax. Normally the tax payable should be shown as a current liability, unless they have paid the taxes, but that is very impossible because before preparing the financial statements, they can't pay taxes. They can pay it in advance, but they can't pay the entire amount. So this financial statement seems to be totally having a lot of problems in this one.
Right.
So we will be looking onto that one. IFRS 5, I cannot think too much of an application of IFRS 5 unless there's a very specific one. What is IFRS 5? It is non-current assets held for sale or discontinuing operation. Discontinuing operation, right? Now, if you do a film halfway through and if you decide to discontinue, I don't think it is a IFRS 5 asset. IFRS applies for non-current assets. Non-current assets that we want to dispose it. Or a subsidiary where you are thinking of disposing it. Right? That can be shown, but they are not given the individual company's financial statement. So I cannot see IFRS 5 coming up in a big way unless they decide a certain asset, a property, plant or equipment, they decide to dispose it in the next year. You remember there are three things that need to be happening in that case. The asset is available for immediately for sale. In other words, if a buyer comes tomorrow, it can be sold. If it is subject to some negotiations with the unions or something, you can't sell it. Then you have taken reasonable action, like appointing a real estate agent or some person to do the sale. Thirdly, there's a likelihood that it will be sold within next 12 months. If all those preconditions are met, then we can show that particular asset not under non-current assets. just below current liabilities, below current assets as a separate line item called assets held for sale, non-current assets held for sale.
Right.
I can't see that very much in this case because they don't have too many non-current assets. But anyway, for what it's worth, let us know, because they might put up a question and ask what are the conditions that we need to be made if we have to classify something as a discontinuing operation or a non-current asset held for sale under IFRS 5. So number one, the asset should be available for immediate sale. Number two, constructive action has been taken, like appointing real estate agents or brokers or advertising to sell. Board has taken a very firm view it must be sold. Fourthly, that it is probable that it will be sold within next 12 months.
Okay.
Then the next accounting standard what you have asked is about the IFRS 10. It's all about the consolidated financial statements. So what basically we know, if we whenever we acquire a subsidiary, we need to consolidate it. Any company where we have a controlling interest over another entity, we should be consolidating unless there are very specific reasons why it should not get consolidated. The consolidation, a goodwill will arise, and in the consolidation, the whole thing will go through. Still, it is a subsidiary. The moment you decide to dispose the subsidiary, or the moment you dispose the subsidiary, it's no longer consolidated. So maybe halfway through the year, you might decide to dispose a particular subsidiary. In that case, 6 months it will be consolidated. The balance 6 months it will not get consolidated. But the statement of financial position, you must always remember, it's not for a particular year, it is for a particular day. So if a particular subsidiary has been sold halfway through, in the final statement of financial position, it will not appear. That subsidiary will not appear. But profit and loss will have half consolidated, half without consolidation. Then after the next one is IAS 28, not IFRS 28. It's all about the IAS 28. It is all about investment in associates and joint ventures. Now, what is an associate company? Where you have a significant influence.
Interest, yeah.
Not a control, but a significant participate. You have a very unlikely these people have any companies like that. But I can see joint venture coming up here. They might join with another party to do a fill on a joint venture basis.
Right. It can be a co-production, right?
Co-production, exactly. Right?
Yeah.
Rather than, some party might come and say, we can't give you 60%, come 50-50, we will do a joint production. Or 3 parties can come and do 33 1/3, 33 1/3, a joint production. Joint means no one has no control. No one can control the other party, but they jointly control the company.
Right.
In that case, the IAS 28 will apply for joint part. So the joint part, what we do is we take the equity accounting method and apply our share of our profit and then show it separately, just like a associate company scenario.
Right.
So we will see whether we can look at some of these areas in our mocks in the time in days to come, whether we can get any of those items into our mocks. So these are good. So I believe IFRS 3, IFRS 10 will have a lot to do with it. And also the IAS 3, the presentation, because a lot of concern about the presentation they have made. So IAS 3, not IFRS 3, IAS 3. Also, I would like to see for you to just to get an idea of the presentation that is recommended by the International Accounting Standard Body.
Okay.
If you look at this consolidated statement, they have revenue, they have expenses, they say direct operating expenses, distribution and marketing, administration, depreciation and amortization, all that is shown. normally in our presentation, we don't have all that. We show revenue, cost of sales. But nothing wrong, because that presentation what we are given there is the kind of minimum disclosures. This kind of a presentation, there is nothing wrong in it. Right? So total expenses, so then they call it operating profit. And but only problem is you can't compare this with another company's financial statement. So this may be a problem, even though it may not be wrong. It's difficult for you to compare your company with another company unless you restate some of these figures.
Right.
Because the revenue minus direct operating expenses may be the gross profit. Right? Maybe the gross profit. After that, distribution, marketing, administration, depreciation. You can see the word depreciation and amortization coming up, and that shows there is some intangible assets getting amortized. You have the mind, right? So depreciation and amortization, the word to remain the two words together, it shows there is some amortization. But we do not know what has been amortized, because the goodwill cannot be amortized and goodwill is not amortized. Finance cost, we can see it has gone up from 48 to 40, and then the profit tax, we don't see any taxes being payable, so we do not know where it is accounted as payable. So these are some problems we have. Non-controlling interest is not there. So it may be a question, a very general question. Some person might say this financial statements of ours is appears not to be in accordance with the IFRSs, and can you highlight the areas in your where you feel the IFRSs are not properly applied for? I'm not in a question like this, but I can sense a question like this, because it's the first time I've seen such an erroneous presentation of a statement of financial position in our case studies. And being IFRS company, if it's a private company, it's all right anyway. But if it's a being IFRS company, for them to have this kind of a thing, I think there is something big wrong here.
Right.
So we will. So the loans, the current part of the element should be shown as a current liability, which is not shown, and so there are many areas where we have to. So that's something which I just want to get it. So shall we look at the mark we were doing? I think we were doing on that actor issue about our friend who was going through some kind of a thing. And so basically, the first part I think we discussed last time. How can we organize our value chain or supply chain much better to prevent a recurrence? So we should have been much more sensitive to the media news which is available for us, right? And it's not only the actors. In this case, it is about actor, but even about the other areas. We need to consider the two links in the supply chain. One is the procurement from third parties. In this case, there can be many third-party procurements coming up, and also the conversion or use of those materials and people in the production of the film.
Right.
So that is what we discussed that then. So we had to investigate the reasons. We should have been much more careful with particularly the film cost, because that's a big area in our operation, a critical success factor. We should have been more sensitive, and also we should have had a kind of a code of conduct established, so that people will behave ethically. That should have been something that we should have done it.
Okay.
Then second part, how can we address the inevitable claims that we have acted unethically and against the public interest? So just to go back on this one, you remember what happened here was, we had this actor and being funny with one of our young upcoming co-actors, and a reporter disguised in a form of one of our workers and worked in inside our company on this film with a little bit of a video gadget, and he videoed some of these naughty doings, and later on he came to the producer of the film and said, is it all right? Should we not terminate all that kind of a thing? Our producer said, he is more valuable to us than the girl, and it's nothing to do with us. We don't need to take any action. Let's forget about it. That is what the whole story came up, and this whole thing was shown because the producer said, just turn a blind eye. Don't worry about what is happening between them. He is comparatively cheap, and because of his low popularity, and we can always replace the girl, but difficult to get a main actor for this price, and therefore, so far the lady has not complained, so just ignore the issue. So the whole thing, including the speech, was shown on the TV prime time. This is what happened. So now the question is, how can we address the inevitable claim that we have acted unethically and against the public interest? So whenever there's an issue like this arising, anyway, what did you think about it? What did you think about it? How can we address this particular issue that we have acted unethically?
We can come up in front of press, like, and give our stand on it, like, we are investigating it, and like something like that. That we are not sitting and doing nothing. We are looking into the matter and trying to make the situation good.
Yeah. Okay. Yeah. Now there are three options. There are two options available when an issue like this arises. One, we can just completely ignore. We can completely ignore. Second one, we can completely deny it, the existence of that one. Third one, we can admit, accept, and say that we are taking corrective action.
Right. Yeah. That's yeah.
So you must try to discuss the three options. I mean, not to discuss it at length the three options, but at least to say these are the three options available for us. And then say straight away it will be difficult and possibly counterproductive to argue that we have behaved ethically. To say that we have behaved ethically when everything is showing that we have, whether it's our producer or whoever, when they have ignored the ladies, whatever the damage or whatever, we can't say we have acted ethically. So it will be very counterproductive to say that we have behaved ethically. We have knowing, we came to know about this, knowing we are still keeping our main actor, saying that he is more useful to us than the other one, and all that kind of a thing. So any defense that we are trying to offer will be interpreted saying, will be interpreted saying that we intend to continue to do and to encourage this kind of sexual abuse, which is totally unethical and maybe even illegal.
Okay.
What we can do is we are caught. We can't deny our wrongdoing. But what we can do is we must engage in some type of a damage limitation by offering some mitigation. Right. To do some damage limitation by offering some. This is exactly what you were talking just now. So the board will have to take a decision very firmly whether we should still continue keeping this main actor in our company.
Okay.
We have already signed some more films with him, which is on the production process. You have to decide now, when we have come across a situation like this, what are we going to do? So the board will have to decide, but probably your recommendation will be not to continue with him.
Right, yeah.
not to continue with him, because it's a considerable damage, because even for the next films the other co-stars may not want to act with him at all.
Yeah, exactly.
Right? So you will probably make a recommendation, but you will say the board will have to decide on that part of it. And if the board decides to discontinue, we can say that to the press, we can say we have taken action to discontinue his services. But you can't say that we are going to discontinue and continue him. That is more unethical.
Okay.
I remember there was a question sometime like that, because when the news was very hot, they just came on media and said they were going to, it was not discontinued or something else, we are going to do something. But after that, they, the idea was not to do, the intention was not to do, but just to, just to put that story out saying, yes, we will do, but later on you forget it. People also forget it after some time. So that's unethical. You must have the intention. If you are very firmly decided that you are not going to continue with him, then you can go for that kind of action and tell. And tell the media that we will no longer have any associations with so and so. All our future films will be terminated, and our current film also will be terminated if the board decides on that kind of a thing. And also you can say that we will discuss this matter with our co-star Anita, and see how and to ensure that she's protected for the future from any this kind of abuse, and also to apologize for our James statement saying that it is not the board's way to tolerate this kind of a scenario. So that kind of a answer should have been all right, because we have to accept that we have behaved unethically. What we can do is we can minimize the damage. This thing.
Right.
That's what we can do. Right? And yeah.
I have two questions here.
Yeah, sure.
How does SEMA ethics, SEMA code of ethics, which is like objectivity, integrity, I mean, can we apply that here?
We have to apply it here. Yeah, right. Very good question. You must apply it, because you can say, for example, according to SEMA code of ethics, we must be truthful. We must be of integrity. So if you are going to terminate his services, we can say truthfully that we are. But if you are not going to terminate, but we say, then according to SEMA code of ethics, we are not of integrity. And also about the professional behavior.
Yeah.
Right? Professional behavior. We must ensure that all our people, the SEMA, you can say, for example, SEMA code of ethics, no one should bring any disrespect to SEMA institution, whether it's on or off office hours, work or not, you must not bring. Similarly, our people should not bring any disrespect to our company through their behavior, whether it is during the film shooting or off film shooting. Always on an ethical question, apply SEMA code of ethics.
Ethics, right. And one more question.
Yeah, sure.
Like if we terminate his services in the present in the present movie, we do have a risk of industrial action, like in terms of
because I think they said no. Our lawyer said Ella believes that we can expect a large claim from Stan if we terminate his contract for Summer Night, and even Anita may lodge a claim against us. Yes.
How do we deal in that situation?
Yeah, we have to. We can address that one. If he decides to make a claim against us, we will have to go for legal advice and see how we can mitigate the claim. But still, even if we had to make a compensation for the long-term success of the company, for long-term reputation of the company, it is good to pay that kind of a claim and to terminate his contract, not to associate with him anymore.
Right. Okay. Okay. Fine.
You understand? Sometimes, we can't avoid it. If the legal systems are different from our ethical systems. Legal systems might look at from a different angle, the lawyer will argue it was with the consent of the so-and-so that it was done and all that kind of thing. When you go to courts, there can be many legal arguments. But what we have to respect is the ethical standard. So maybe we have to pay something because that lady, our legal lady says we have to pay something. We will be subject to a big claim. That's all right. Even if it is so, we should be still maintaining our long-term reputation because if we don't go for that one, we might be in a bigger mess than paying the compensation. People will respect us even though there's a little bit of a damage or not a fairly big damage done by James, but I think people will still respect if we decide to terminate and to admit, accept rather than trying to deny and to be, arrogant. We all make mistakes in business, in our personal life. It's good to accept it more gracefully rather than try to fight it more disgracefully.
Right.
This is the stand we must always take as CIMA members. One might argue it in a scenario like this, another person might argue it, but what about our responsibility towards our shareholders? If you mean to say that if the company is made a big claim, what about the fairness of the shareholders? True enough, right? We have to mitigate the claim. We have to make facts and make the claim much more mitigative. So for this, one document that will help us is what we call a risk register. Risk register. What is a risk register? Risk register records all the risks what we have encountered in the past and the actions we have taken.
Right.
So even to the courts, if we can show that in a similar situations in 2015 or in 2010, this is the action we have taken. The court will see this company is behaving in a way that is more ethical. They might take the legal stand and put up a claim, but the claim will be a very minimal claim. So even this transaction should get recorded in the risk register for the future.
Yeah. Okay.
So that's what we should be looking at, that one.
Right.
So you can have many ways because from the shareholders' point of view, we have a responsibility to maximize the shareholder value. So this thing can go into disruption, all that, but we have to think of the long-term consequences of continuing with him.
Right. Yeah.
Ethics always should take priority over your profits because most of the time we are criticized because sometimes we measure the profit, not the ethics. But we have a responsibility towards, just like as we have a responsibility towards our shareholders, we have a responsibility towards our crew members to ensure their protection, to ensure their needs are properly cared for.
Right. Exactly. Yeah.
Yeah. Last one. Can we take any action against James for not informing the board about his interview with the reporter? Can we take any action against James for not informing the board about his interview with the reporter?
James was not very sure. I mean, James wasn't knowing of the fact that he's being recorded on the television, but he did act unethically. So I think action should be taken on him because it's actually damaging the reputation of the whole company, isn't it?
Correct, because the whole film can come to a collapse because of if James has taken the action immediately. If James told yes, we will take action, I will inform the board, the reporter would not have put anything against the company on this matter. Isn't it? Right? If James has taken a stand, yes, we will take action. I will inform the board and let the board take action. James would have been very nice and no action could have taken place. But James, by saying all those things, saying that, ladies, the man is more important than the lady, he is just saying, because he is a company senior employee, when he says that, it is the company's weak. But we also have a problem. Our problem is, have we kept James and the other producers briefed on our code of conduct? So we have to look at from that angle. We can take action if James has breached, if there was a code of conduct and James has breached it. So we have to take action against James, but the action will be somewhat mitigated by the fact that we have not communicated to James and other people about the code of conduct in situations like these. So we cannot take any strong action against James, but except to warn him. But arising from this, immediately what we need to do is we have to set up a proper code of conduct for the film crew and our own staff. And that must be properly introduced, refreshed, and any violation of that code of conduct, we could take action. That's how you must try to analyze it. You have to be very, very long, sort of outward thinking on a long-term basis. Because we are not told James. Because recently in our church, we test some of our young people for preaching and all that kind of a thing. So one girl, I was also in the panel to test her ability to preach on the church. So she came and she did a very good thing, but particular portion of the Bible that should have been taken, it was not taken. Normally when it is not done, you have to fail her. But I argued and said, did we tell her that, that she must take that part of the scripture and do it? If you are told and if she had not done, then she is wrong. When we have not told, we are wrong.
But Kumar, isn't that the case where whenever you appoint a producer or anything like that, right? You have a professional code of conduct in place anyways, right?
That is why we can't take it for granted because they have not told that we are having it. True enough, generally. But, if you look at many other companies, we don't have a code of conduct. That's why I said if we have a code of conduct and if that was there, then we could charge James for breaching the code of conduct. If there is no code of conduct, we cannot take severe action against James.
Right,
That's right. Because if they are told there is a code of conduct, we can't. Yesterday I was looking at a operational case study, the supplier's code of conduct. There was a code of conduct introduced by the government. And the moment you breach, you have breached it. You don't need to talk about anything. You have breached it. So you have to look at from that angle because you can't take anything for granted. In a case like this, saying that we have a code of conduct or for us to say it is common sense to have a code of conduct. No. Do we have a code of conduct? Because, companies can become big, but still they may not be having the code of conduct. Now, CIMA has a code of conduct. Because CIMA has a code of conduct, none of us can breach the code of conduct. But if CIMA is not having, they can't take us to anything if we breach anything.
Right.
That's what we have to be looking at. So like that, you can go on this. So this was also fairly all right. A good question where we could take a lot of things out of it. So shall we fix some days, Veena, next week? How is your program like?
I'm fine for any day now because it's as if I'm feeling as if I don't know nothing. When I sat for the mocks, I mean the mock you have forwarded, I couldn't think of anything. I was like, God, what am I going to do in the exam?
No, don't worry. Because don't try to lose your confidence. Try to think very common sense. Don't try to think of very technical, big technical things. You have got your knowledge. try to think as if you are working in a company. When a issue like this comes up, what are we going to do? Just take like that. Don't try to bother too much about it, because don't try to apply stress to yourself. That's going to be your killer.
Yeah, but when you sit for the exam and you have the clock ticking as well,
I know.
you
Yeah,
just
it's not very
sort of
easy.
ideas.
Yeah,
Yeah.
it's not like this, because it's a stressed environment. You're going to work it through. So look at all the past mocks what we have done. Look at all that. Just go on doing it. Just be relaxed and just do it. You must be having your own religion. Try to depend on God above for many things. Some things, certain things which we cannot do, He can do it. So just depend that He has a plan and go on with that kind of a relaxed atmosphere. But I'm free even tomorrow. I think I should be all right even tomorrow if you're free.
Yeah.
Shall we make
Right.
it
Yeah, tomorrow I'm free.
tomorrow? Shall we make
Tomorrow
it
Sunday, like what time?
same time or maybe 12 noon? I can do it.
Yeah, I don't mind. 12 is fine with me.
Yeah. Shall we make it 12 noon tomorrow? So tomorrow we can do it. Monday also, I think Monday also I can do it about 12 noon, Veena, if you are free.
Yeah, I'm fine.
Yeah. So shall we keep for the moment these 3 days? Sorry, Saturday, Sunday, Monday. Tuesday I may not be there because Tuesday my wife's injections are there. But later on, once we meet on Monday, we can fix up some more days. But I'll try to work out more days for you.
Okay. And Kumar, just a question.
Yeah.
Like, we can do as many mocks, right? I
Yeah.
mean, like, I want to do maximum of what we
Yeah.
can
Correct.
get out
Yes.
of the pre-games.
Yes.
So,
Yes.
and if I have any questions, I need to
Sure.
be like, yeah. So basically, I can discuss with you and get some ideas out of
Definitely.
you
No
as well.
problem at all. Yes. Yes. Yes.
Yeah.
Yes.
So that's it.
You also look
Yeah.
at anything, if you come across, look at some of the, if you can go to SIMA Connect past papers, you might see certain areas, certain issues. In fact, I'm working mocks on most of those past areas. So you can look at some of the things and see whether there's any particular area where we can, just like what you asked about the accounting standard, just look at. If you come across anything, let me know. We will try to work it through.
Sure. Okay. No problem.
Right. So
Right.
I'll see you tomorrow at 12 noon. And
No problem.
we will look at some of the marks what you have in hand also.
Sure, Kumar. Okay.
Okay, take
Thank you
care.
so
Have a
much.
great day.
Yeah.
Bye.
Okay.
Bye.
Bye. Bye.
Bye. Dishan, කීයටද වගේ එන්නේ Dishan? Right. Right. හරි හරි නෑ කමන්න එක මම මෙහෙම කරන මම ඉදිරිපැත්ත තියෙනවා මේ හරි right after 8:30 okay no problem මොකද මම කෝල් කරේ මම කේසි පාදුනාංශගේ සර්විස් එකක් තියෙන ඉදිරිපැත්ත මම ඒකට බලන්න යන්නේ කියලා බැලුවේ මේ හරි මහන්සි නම් හෙට ආවත් කලබලයක් නෑ එච්චර right okay no problem right okay so I thank you right okay